Ladies and gentlemen, welcome to video number 3 of School of Accounting and Finance for Learning It Quick's AFM101 instructional video. My name is Dinesh Balakrishnan, and today we're going to be taking a look at the balance sheet. That's right, the statement of financial position, or what I like to call the ALO statement. And why do I like to call it the ALO statement? It's because of this. Because A equals L plus OE, ALO. And this fundamental equation is the basis for this particular financial statement. So let's just jump right into it with the purpose of the balance sheet. Now, if you haven't already taken a look at the previous video, which explains the different types of financial statements, you might be a little lost right now. But if you know what I'm talking about, then let's just carry on. So why do we use the balance sheet? So a balance sheet, as we know it, as we've defined it previously, is sort of the snapshot of your financial position right now, as it stands at this very moment. So why would a balance sheet be useful? Well, let's take an example to illustrate this point. Let's meet our friend Jim. Jim's a happy fellow, right? Jim is the sole owner of a company named Jimbo Incorporated. Now, Jim owns Jimbo Incorporated, and he's pretty happy. He's it's a decently run company. But recently, Jim has faced a little bit of problem because he's short on some money, and he needs that money to run his business. So he approaches a bank and he says, "Look, bank, I know you have a lot of money, and I need to borrow some money from you." So he approaches the bank and says, "Look, I need to borrow $100,000." And the bank says, "Well, wait a minute, Jim, that's a lot of money there. We're going to have to take a look at your financial statements." In particular, what the bank is going to ask for is income verification, but also they're going to have to look at Jimbo's net worth, right? So they're going to have to look at Jimbo's net worth, which will be found by looking at their balance sheet, or the statement of financial position. So by looking at the balance sheet, the bank can assess whether Jimbo Incorporated has enough assets in its books to cover the liability that it's about to incur. So in the event that, Jimbo Incorporated goes downhill, it's unable to make a profit, then if it ends up going bankrupt, the bank has assurance that Jimbo has enough assets that it can liquidate or sell to recover the money to pay the bank back. That's one of the reasons why the bank would probably want to look at Jimbo's balance sheets. Well, they're probably going to want to look at all their financial statements, but in particular, the balance sheet's going to serve this purpose. Here are a couple of the account names that you're likely to come across in your textbook, and these are some of the more common ones. But I want to make a distinction right here, because everything that's sitting on this side is pertaining to the income statement, so we're not going to worry about that right now. But anything that's on this side, take a look at right now, because all of this pertains to the balance sheet. And there's some accounts in here that may seem a little confusing at first, so things like, what an intangible asset? I mean, we don't even know what you're talking about. How can something be intangible? Well, there's many things that can be intangible, like trademarks, copyrights, patents, and we still have to account for those, so we treat those as intangible assets. There's a couple of other things you might be wondering. What's unearned revenue? How can you have revenue that you didn't earn yet? Well, those are concepts that we're likely to explore in a later video, but just for the time being, these are some account names that you should probably get familiar with as you explore this course in more detail. And to understand the balance sheet a bit further, let's look at an example of a balance sheet that I pulled up from a Google image search. So immediately when I look at the balance sheet, the first thing I look for is this part right here, the header. This part, it gives me the crucial information from the start. So I look at the business name that I'm looking at, the type of financial statement I'm looking for. In this case, it's the statement of financial condition, or we can even call it statement of financial position. So that's there. We know what time period we're talking about, December 31st, 2008 and 2009. So it's a comparative. It compares 08 and 09 figures. And also the currency that they're talking about is dollars in thousands. So we, tack on 0, 0, 0 to each one of these, and that's basically the balance sheet right there. You know, before we mentioned that A equals L plus OE, it's probably important to test that theory right now. So let's look at the total assets. We have here is 13,210, and if we also look down here, total liabilities and owner's equity is also 13,210. Well, what is total liabilities and owner's equity? It's the sum of total's owner's equity and your total liabilities. So it should be given, oh, I don't think it's given here, but if you sum everything up in this bottom right here, it should sum up to 13,210. And if a balance sheet is out of balance, then you know you're off to a bad start already. So first important check you can make is to see if all the assets total the liabilities and owner's equity. Here's another example of balance sheet that we'll look at to the right here. Ignore the income statement and the statement of retained earnings to the left. But let's just look at this balance sheet right here. So again, we're looking at what company we're looking for, the type of financial statement we're looking at, the time period we're talking about. In this case, they've given us the dollar figure, so we don't need to worry about what currency we're dealing with. But one important distinction I want to make between this type of balance sheet and one provided up here is that this is comparative in nature, right? So it's comparing 08 and 09. It's giving us 2 years. And this one is sort of a standalone. It's just giving us 20x3. Or, I mean, you can substitute the x for any number basically, but it's a standalone balance sheet. It's giving us a snapshot of one particular year, and we can do pretty crazy things with the balance sheet. We can calculate a couple of key ratios that we can use to assess or analyze if the company is progressing as it should. One very important ratio that we look at is the current ratio. Now the current ratio, I'll write it down, current ratio is your current assets over current liabilities. A current ratio measures basically for every dollar of liability, a current liability, if you have a dollar of current asset to meet that liability. So in this case, you know, if we had to figure out what our current assets are, well, it's cash and accounts receivable. Why? It's because current assets is anything that can be used up within one operating cycle or one fiscal year. And equipment clearly is not the case, because you have equipment for long term. You have a year over year. And in liabilities, we have our accounts payable, which is likely to be due within the year. We have salaries payable, because your employees are likely to be a little ticked off if they don't get their salaries in the year. And interest payable for any notes, in this case the note that we're holding in our books. So if we sum these, if we look at 15.5 and 4.5, this comes to 20K. And we look at the sum of these three figures right here. If we sum those, then we should get 7,200. And if we do 20,000 divided by 7,200, and lo and behold, we have a current ratio of 2.78, which is an excellent figure by any means. And it's kind of confusing to look at this number on its own, because it's without any context, but you know, usually you have an industry standard to weigh it against. But 2.78 is a very good number to look at. There's also several other ratios you can look at, like return on assets, which is just your net income provided in your income statement divided by your total assets. So you can play around with a bunch of these figures from various financial statements. But I want to end this video off with a challenge to you, because I want you to try and prepare your very own balance sheet. And think of the assets that you have, like if you own a computer, or if you own textbooks, or any sort of assets that you think you own. I want you to list on one side, and on the other side I want you to list all the liabilities you're likely to have, like OSAP, other student loans, or credit cards. What else can you think of? Any sort of thing that you're likely to owe somebody, I want you to write on the other side. And if you can find the difference between these two, because we know that assets, because we know that assets equals liability plus owner's equity, if we just take this and put it on the other side, we know that assets minus liabilities will become your equity. So you're trying to find out your net worth, right, by subtracting these two. If it's a negative number, which is likely to be, because obviously you haven't earned income or anything like that. But if it's if you do end up with a figure, I'm sure you'll be pleasantly surprised at what you can calculate. So that's my challenge to you, is to prepare a personal balance sheet and think of your assets, liabilities, and find your own net worth. It's a great exercise to try and understand this, and I'm sure it will help you in the long run as well. So take care and stay tuned for the next videos. I'm likely to shell these out in the next coming weeks. So it's going to get a bit busy because school term's going to start. But best of luck, take care, and catch you soon.